Okay, Dave, well, thank you very much. So what I'd like to do for tonight's presentation is just share my perspective from the outside looking into Alberta and share with you what I see that's going on. So tonight what we're going to cover is what is happening in the real estate market, in particular in Alberta. Why is now a good time to be investing? What should we be looking at to purchase? And where should we be buying? Now, I'm sure everybody has heard the old saying that the rich get richer and the poor get poorer. This especially happens during the economic downturns. Now, the question is, why is that? Now, I have a belief that there's two reasons. First being ignorance and the second being fear. So let's take a look at what actually is going on in Alberta. Alberta's economy is doing worse than expected, according to TD reports. The Canadian Press from Statistics Canada, Alberta has lost more jobs last year than in any year since the 1982 recession. These are revised numbers from Stats Canada. So you're getting nothing but doom and gloom news. So this is going to create lots of fear and anxiety in people. Then the next thing they hear is that there's this mass exodus of people leaving Alberta. Well, yes, there are certainly people leaving Alberta right now, but they had droves of people coming in before, driving the prices up. So again, most people's perception is that everybody's just leaving Alberta in droves. And this is why, from an educated investor's perspective, I believe that Alberta is on sale now, and there's lots of bargains to be had. So why is it on sale? Well, there's a variety of different reasons. Low oil prices is certainly hurting the economy, and it's creating high unemployment in especially the high income earning jobs. So that's forcing people to take on lower paying jobs. People are definitely leaving the province, going to other areas, maybe back to their original place of residence, looking for other employment. And then there's the new government. So with the new NDP government, which is they have a very strong socialist agenda. There are fears and concerns that they're going to change the Residential Tenancy Act. They already have made some minor changes to the act, and there's rumors that they're going to be changing more. There's also rumors that they're going to be bringing in a new sales tax. Will they bring in rent control, which can greatly impact the investors in the province as well? Now, there's other reasons for a potential real estate market crash as well. For example, you could have overbuilding. And a perfect example of this is in the markets of Toronto, Vancouver, and Calgary, where they've been building condos like crazy for the past number of years. And investors have been gobbling them up and then renting them out. But at a certain point in time, they're going to reach a threshold where there's too many for the market to absorb. And when this happens, then the market's going to adjust. The prices are going to come down. It may affect only the condo markets, or it could spill over into other parts of the market as well. Then there's the affordability. I mean, as the prices of homes go up, fewer and fewer people can afford the home. So again, it'll hit that tipping point where people can no longer afford to buy the homes, and the prices will have to be adjusted. And then there's the straight out economy. If the economy itself crashes, either the local economy or the economy throughout Canada, then that can definitely have an impact on the market as well, especially if you have a single industry market such as the oil industry in Fort McMurray. Rising interest rates can also greatly impact the housing market as well, and then foreign markets. People don't give a whole lot of thought to what's going on over in China or Russia or any of these other foreign markets. But when these foreign markets stop buying our goods, stop buying our raw resources, then that definitely affects our markets, puts people out of work, people lose their homes, it affects the stock market, it affects the real estate market as well. Now, what we need to realize is that bad news sells. There's Peter Diamond's wrote an article and in a magazine called "Why We Love Bad News: Understanding the Negativity Bias." So we are mentally wired to look for danger, yet in today's media, danger is linked with negative stories. So that the media knows that that's what we're automatically drawn to. And this is why 90% of the news stories are considered bad news or negative, because people are attracted to this bad news. So, keeping that in mind, what do you think you're going to be bombarded with? You're going to be bombarded with all kinds of bad news. So is this a real surprise to you? I think if you watch the news, you'll see that very little of it is good news. Actually, in our local news broadcasting here, they end, and they consciously say it this way, they end the evening with a good news story. So one good news story out of the whole 60-minute presentation. So what about all the good news stories? Well, you're not going to hear much of that, and that's why the average person is experiencing all of this fear and worry. We know as educated investors that there is good news out there. It's just not being shared and or heard by the average person. We also realize that real estate is cyclical, meaning that what goes up must come down, but also what goes down will come back up. And this has been proven time and time again in real estate. So here's what the investment cycle actually looks like. Now this can be applied to the stock market or real estate. It doesn't really matter. But people buy at a certain point and they experience increase in valuation. Now, in the stock market, their prices simply go up. In real estate, the vast majority of people in real estate are homeowners or uneducated investors, and they're buying for appreciation. So they enjoy that ride of appreciation, and they don't ever think that it's going to stop. When it does start to change, though, and it goes down in value, they start to experience some anxiety and maybe a little bit of denial. And that's what happened with the oil industry. In the first 3 to 6 months, many of the people believed that it was just a blip in the market, that the market would rebound and things would continue on as they have for the past 10 or 15 years. But that didn't happen. So then fear and despair started to set in, and eventually panic started to set in, especially for the people with the high income paying jobs, because these individuals were living at or beyond their means. And as soon as they no longer had that income, they could no longer sustain their lifestyle. So they were losing their expensive homes and having to downsize. And they started to see the prices, as they started to sell, and more people started to sell, they started to see the prices in their market going down. And that just sets off panic. So people start to sell before the prices get any lower. Eventually, that does bottom out. It always does bottom out. Where is the bottom? Nobody really knows. But then things turn around, the economy turns around, jobs are starting to be created again, and the cycle starts all over. So that's how the investment cycle actually works. So that begs the question then, when is the best time to actually buy? Well, the obvious best time to buy is when the real estate cycle is at the bottom. But when is that? Nobody really knows when that is. So realistically, the real true best time to buy is whenever the property makes sense and it cash flows. It makes a profit for you. Now, when the interest rates are low like they are now, you stand a better chance of it cash flowing. When house prices are dropping like they are right now, you also stand a better chance of cash flowing. When the banks start to tighten up the lending criteria, which they're doing right now because they feel that the real estate market is too hot, so that's one of the ways to control the real estate market. What they do is they start to become more conservative with their pricing. They instruct the appraisers to come in at the low side. The appraisers themselves are being conservative because the last thing they want to do is appraise a house only to discover that a year or 2 years later the value of the house is much lower, and then the banks come back after the appraisers because they overappraised the value of the house. So the banks, with this lending criteria, they have fewer qualified buyers chasing the properties as well. So these are all really good reasons to justify why now is the best time to actually buy. So again, are there discounted houses? Are there motivated sellers? Is there potentially better cash flow in the properties that are out there now? Can you ride the wave of future appreciation? Is there less competition from the uneducated investors out there? Are the interest rates at historic lows right now? Can we get better terms through vendor takebacks or inclusions when we're negotiating today? The answer is yes. But the question is, why is that? So let's take a closer look as to why. So again, the best time to buy, when you take a look at that investment cycle that we looked at earlier, we said it was at the very bottom of the S-curve. Well, the best time to buy is actually just as it's starting to rebound. That way you can see that the trend is to move back up. It's now safe to go in. You've missed the bottom, but you're catching that wave going up. So is it a buyer's or a seller's market? Well, what is a seller's market? A seller's market is when there's more buyers selling their houses than houses available. Sorry, more buyers looking for houses to buy than there are houses available. And this is what was happening in the early 2000s. There was lots of people coming into Alberta. The oil industry was taking off like crazy. There was lots of jobs being created, and there was a shortage of houses. So sellers selling their houses could ask pretty much whatever they wanted, and there would be multiple offers on a house. When you're in a market like that, the house prices go up. A balanced market, meaning that there's an equal number of sellers and buyers out there. There's always people buying and selling, moving for different reasons. But when the economy is relatively flat, neither growing or shrinking, things are pretty stable, then the prices are going to remain stable as well. And then you've got a buyer's market. A buyer's market means that there's more sellers trying to sell their properties than there are people looking to buy their properties. And an example of this now is, as you know, people are leaving Alberta, they're walking away from the homes, or they're losing their homes because of mortgage default, whatever the case may be. There's more sellers of properties out there than there are actual buyers. So when that happens, the prices actually go down. And that's exactly what we're seeing in the Alberta market now. Now, it's not a huge buyer's market. It's slightly lower than the balanced market, but it is definitely a buyer's market. And when you're in a buyer's market, that means you get motivated sellers. And when you have motivated sellers, there's a lot more flexibility and opportunity for you as a buyer. So one of the things that you want to take advantage of is appreciation. And as I said earlier, yes, what goes up does come down, but also the market will come back up as well. And here you see the trend has been from 1975 to 2009. It has gone up and down, but generally speaking, on an upwards trend, 6.2% annually. From 2009 to 2013, it dropped dramatically again, but it rebounded. In 2013, the values were as high, if not higher, than what they were in 2008. Then there's the residential bank rules. So at one point in time, you could get up to 100% financing when you're going out to buy a property. That is no longer the case. Today, what it is, and I'm talking about for investment purposes, you need to come up with 20% down. Well, when that rule first came out, a lot of my students had the mindset, well, that's going to make it much more difficult for us. And yes, it's going to make it a lot more difficult for a lot of investors in the game, which is good news for you, though, because that means there's fewer investors chasing those properties, so less competition for you. So that's actually a good thing. At one point in time, the banks didn't really care where the down payment comes from. Again, that is no longer the case anymore. In fact, the banks have had to follow some pretty strict guidelines set out by the government as to where the money is coming from because of money laundering, etc., all the illegal sources of money. So as a result of that, investors who struggle to raise capital or have limited amount of capital, again, in the mindset of many, they think it's too hard, so they drop out of the game. There's fewer investors for us. It used to be that you could have as many residential mortgages as you want, providing that you could qualify. And again, that is no longer the case either. The bank has changed the rules just recently within the past year. So now you can only have 5 residential mortgages, including your own personal residence. So even if you can qualify, it does tie your hands. Even if you're going to do joint venture deals with other partners and you want to be on the title, you can't do it because you're on the mortgage as well. Therefore, that knocks even more competition out of the market for you. So fewer investors again. So again, most uneducated investors, they're going to experience these roadblocks and they're going to give up. So when the finance rules are changed or they need more of a down payment and they can only have 5 mortgages or they're running out of money, I can't find the good deals. These are all excuses that they will use in order to stop investing in real estate. And that is good for us because that means there's fewer people chasing those rental properties, which also means that the prices will start to come down. Now on the commercial side, commercial has bank rules as well. A lot of people believe that you can only do 65 to maybe 75% loan to value when you actually buy a commercial property. That's not the case. You can actually go up to 85% for residential commercial. And residential commercial is an apartment building. They also believe that interest rates are extremely high for commercial, 5 or 8%. And 5 or 8% isn't really high, but in today's market where you can get 2.5%, 3%, 5 and 8% is considered high. Well, that's no longer the case because I'm working on a deal right now with a client, and we're looking at a 10-year term at 2.5%, and it could even go down to 2.1% if he's willing to lock in for a 5-year term. A lot of people believe that it's difficult to qualify for the mortgage with respect to commercial. That's not so much the case either, because what happens is the mortgage is qualified. Or the property qualifies for the mortgage, and then the investor, you have to personally guarantee it, but you don't have to have the cash flow personally in order to carry that property, because the property itself has to carry itself. Banks will lend at any value. Well, that's no longer the case either. The banks were looking for all kinds of things to lend on at one point in time, and it was driving the prices up because the sellers were able to ask above market prices. Well, that's no longer the case. The lenders are much more conservative today, and the appraisers themselves are much more conservative as well. And this is actually forcing property values down to where they actually should be, and they make sense. The conservative lending practices also creates a better environment for vendor take-back opportunities and or favorable terms to be negotiated with the sellers. So we now know why prices are dropping, and we understand why now is a good time to be buying. So what should we be buying, and where should we be buying? Well, let's take a look at what people are selling and buying right now. People are currently selling in the residential market homes in the $400,000 to $800,000 price point. Those are the main houses that are taking the losses, because these are the high income earners that have been working in the high paying jobs in oil fields. The properties that are more popular and being bought up are the $300,000 to $400,000 price point range. And they're also looking for suited homes. This is very popular right now. And for a lot of them, they're not buying anything, and they're simply becoming renters. They're waiting to see what's going to happen with the market, and or they've taken such a loss on the sale of their house that they can't afford a new mortgage. So they're going to become renters for the next 6 to 10 years. So what should you actually be looking for to buy? And this truly depends upon your plan. So you have to ask yourself, when do you want to retire? So how aggressive are you going to be going at this? How much do you actually need to retire? What resources do you have available at hand to help you acquire your portfolio? And then what type of portfolio do you want? Do you want to focus on single family houses, or are you wanting to look at the larger deals, the apartment buildings? There really is no right or wrong plan, but the bottom line is you need to have a plan to understand what direction to go in. Now, if your focus is on the single family homes, then I believe that you should be looking at the price point of $200,000 to $300,000, maybe $350,000. You want to look at properties with walkout basements or separate entrances. Raised bungalows are ideal because you've got the high ceilings, large windows which meet the code, and it also makes it a much brighter living area. You want lots of parking, so double wide laneways, preferably with the garage because you can get additional rent as well. In or near trendy neighborhoods, preferably right up against a trending neighborhood, one that's going through the process of change, because these neighborhoods will appreciate in value, and there will be a ripple effect out into the outlying areas where you're investing. You definitely want to be close to transit as well as shopping, schools, and parks, etc. Now, when you look at the bigger deals, the apartment buildings, I would suggest you look at 12 units or larger. They're easier to finance, and you want the purpose-built. They're just easier to maintain. Ideally, 24 units is an even nicer number to look at because they can then support an on-site. So if you're not able to manage the property yourself, or it's just too far away, then having that on site is a nice feature. You would like to have a walk-up building, 2.5 stories at the most, with no elevators, no high expenses. You want a very plain Jane. So we're talking C quality buildings. These are older properties, outdated, not the prettiest properties out there, but they're the least expensive, yet they still bring in good, decent rents. You're also looking for motivated sellers, and these are people who have long distance ownership and they don't know how to manage the property from a distance. So you're looking for tired and run down properties that you can go in with some sweat equity and build it back up. Having some bad tenants is not a bad thing initially. It's a lot of work, but you can turn that property around by getting rid of those tenants, putting in good quality tenants, and bringing the value of the building up. So then where do you start looking? Well, with the single family homes, you want to look in the upward trending neighborhoods. Focus on the lower middle class, which services the largest demographic. And as these high income earners are forced to move down the scale, this will provide a good source of buyers for you. You want to be in a market that's got some diversification. So unfortunately, Fort McMurray, when things are going great, it runs smoothly, but when you get hit with the oil prices, that's when you suffer greatly, and they are by far the suffering the most, not only because of the fire they had, but also just simply because of the drop in oil prices. You'd like to buy in your backyard within a 1-hour drive if possible. However, if that's not possible and you have to look abroad, there's nothing wrong with doing that. You just need to make sure you've got an excellent property management team in place before you consider doing anything abroad. With respect to apartment buildings, again, the upper trending neighborhoods is a preference if you can get there. Unfortunately, there's fewer apartment buildings that are available on the market than there are single-family homes, so a little bit more restrictive. You're also looking at the upper, lower, and lower middle class. You want to avoid the low-income neighborhoods simply because they're not going to appreciate to the same rate, and you're going to have more management headaches. You're looking for that diversified economy, the same as before, because you want to make sure that your tenants have jobs that can pay for rent. Again, in your backyard if possible, and if not, you have to look abroad. The biggest thing that you want to make sure you have in place is the property management team for sure. Public transit is key for apartment buildings because the vast majority of people are not going to have vehicles and they're going to rely on public transit. Plus, parks, shopping, schools, all close by. These are things that you want to make sure are available. So that's it for me. We've talked about what to buy, what's happening in the economy, why things are going the way they are, what to buy, where to buy, when to buy, and So we'll do a little bit better wrap up on that, Dave, then we'll go into the close. So that is 23 minutes long there. So let me know what you think about this, and of course we can dress it up a little bit, but that's pretty much the flow. That's my first time going through it. Check it out, give me some feedback. Look forward to hearing your feedback. Thanks, talk to you later.